My topic here today is buy-sell agreements, and I'd like to think that this topic sort of ties together all the pieces of the earlier presenters we saw here today. Buy-sell agreements come into play when you're looking to acquire a business, start a business, and you have more than one owner. Anytime there's more than one owner, it's never a bad idea to have a buy-sell agreement. But it also covers those scenarios, and kind of the spot where I focus my practice is those areas where business law and estate planning intersect, where we're doing internal business succession planning, whether that be from parents to children or between kind of the current management team and maybe this management team that you've worked to develop so you can be spending more time in Fiji and all the fun places we talked about earlier today, and eventually have those folks take over the business. So today I'm going to talk about really what are buy-sell agreements, why are they important, why are we even here talking about this, what you should include in those agreements, and then how you get started putting those together. And now I see what everybody's saying about this clicker not working so great. To start out with, buy-sell agreements are just kind of a fancy word for a piece of paper, which is a lot of what lawyering, I guess, is about, that control the transferability of a business interest. Often those agreements start out by saying, you can't transfer your ownership interest in this business at all, except in conformance with this agreement. The reason for that is, unlike owning stock in 3M, where we buy, sell that ownership interest on a daily basis, often with closely held or family businesses, we're interested in having a defined group of people that we're looking to be in business with. And so while we may be very happy to be in business with each other, we may not be so happy to be in business with each other's spouses or each other's children or each other's creditors. So these buy-sell agreements set up that structure for protecting the business moving forward. Buy-sell agreements can have a whole bunch of names, and I've got some examples up there on the corporation side. Sometimes they're stock transfer agreements or stock redemption agreements. That's where if the corporation is going to buy that interest back as opposed to the other owners buying it. Cross-purchase is another term, more on the LLC side of things. They're called membership transfer agreements. But again, really what we're looking to protect here is let's help the business keep moving forward, even if something happens in one of the business owners' lives. One of the business owners dies, one of the business owners gets divorced. And so common when we talk about buy-sell agreements is we talk about planning for the 4 Ds. Now there's other things we might also choose to include within a buy-sell agreement, but kind of at the higher level, those 4 items that we're always looking at least to talk about and consider whether we want to include provisions on those are death, disability, divorce, and disagreement. And I've got an example, a local example here about a 50-50 partnership, and they learned the hard way through the Wisconsin Supreme Court about what happens when you don't pre-plan for 50-50 owners and how things will move forward if we can't agree anymore on how to run that business. So why are these things important? Set those ground rules before you need them. I think all of our business attorneys at Bakke Norman really push people when we form a new business. Let's get a buy-sell in place. We might need to tweak that down the road. How we view that may change. How we choose to value the business may change. But let's get some ground rules in play now, because I don't think business owners ever get along better than when we're still in the excitement of the chase and the acquisition and we're getting started. When things start to go wrong, or worse, one of your partners gets a bad health diagnosis, when we see one of these kind of bad events, when we see one of these 4 Ds on the horizon, that makes it a lot tougher to sit down and be rational and divorce ourselves from the emotion and kind of set the rules of the game. Another reason can be dealing with minority business owners. Sometimes we'll have certain people who have large shares of the business, but maybe we've had a plan where we reward long-term loyal employees by issuing them some small shares of stock. So now we have a couple of employees that are 1.5% owners, and then we have one primary business owner. It may be really important in that buy-sell agreement to make sure that those minority folks can't hold the majority hostage. For instance, we get an acquisition offer. Someone wants to buy us up, wants to do a stock sale. Boy, that's great. As Ben talked about, you know, that's a seller's dream. But we've got 1.5% that doesn't want to sell. We can pre-plan for those scenarios within the buy-sell agreement. Tom and I handled a transaction a few years ago where we had 16 different shareholders. And let me tell you, if each of those people could kind of cut their own deal as part of that acquisition, it just would have made that transaction completely unworkable. A deal was a very good one for the business that was selling. So kind of those bring along and take along rights within the buy-sell agreement can pre-plan for, while we've had folks here today say, you know, you can't just sit back and wait for somebody to acquire you, but you know, sometimes that happens. And so pre-planning to deal with those minority owners. The other thing is avoiding unintended results. Sometimes I'll have people tell me, look, the statutes have default rules. You know, those new LLCs, there's lots of rules right in the law books. Why do I need to write up a whole nother agreement? Why can't we just use what's on the books? Well, sometimes what's on the books isn't what works best for you. It's the same thing I discuss often with my estate planning clients, that you don't have to have a will, but if you don't want everything going equally to the kids, well, maybe you do need a will, because those rules aren't going to fit your particular situation. But probably the biggest thing we're looking to avoid is court. Now, the attorneys that I work with that spend their time in the courtroom instead of in the office are probably telling me, shh, don't say this, but I like to say I practice happy law, because really my goal is to get things set up in a way so we avoid court. And you know, some people say, how is it happy law when you're talking about estate planning and death all day? Well, look, these are all good things. You built a business, you have people that you care about that you want to get this transition to. Let me help you do that in the way where we give as little to your uncle, as Ben said, as we possibly can. There was, and I alluded to this earlier, a recent business based out of River Falls that was a 50-50 partnership. Two partners couldn't get along, and so one of them triggered their rights under the law. Again, no buy-sell agreement in place. One of them triggered their rights and says, you know what, we can't run this together anymore. Let's dissolve. Problem was, business never got wound up. Business keeps happening. So one partner is gone, the other one is there, continues to run the business, and each of those owners was getting over $2 million a year out of that business on an ongoing basis. Well, sooner or later, the guy who was doing the work and continuing to generate this profit each year said, hey, I should get the first $700,000. I should get a nice salary for the kind of return I'm giving my partner on his investment. Wisconsin Supreme Court said, no dice. You're 50-50 partners. The job is to wind up, and you don't get compensated for that. So clearly an unintended result, and I guarantee you they not only spent a lot of money in getting each other bought out and getting this business wound up, but they spent a whole lot of money on attorneys to fight about it, from circuit court to the Court of Appeals and all the way up to the Wisconsin Supreme Court to get a decision. So a lot of my job is trying to convince folks that spending a few dollars today is worth potentially spending a whole lot of dollars tomorrow. And so I guess that's really, you know, what I would see as the real value of getting these things set up in advance. So on a real basic level, what do buy-sells include? And I'm going to talk about kind of the three key ingredients. First one is triggering events. When is this machinery of this agreement going to go into effect? Then how are we going to determine the value, if there is going to be a buyout as between the owners, how we're going to set that valuation, and then finally, how are we going to pay for it? So first of all, those triggering events, like I say, often these agreements will start out by saying no transfer is allowed except in conformance with this agreement. And kind of putting on my estate planner hat, I say, you know, consider potentially allowing, if this is a family business, and maybe we have some kids who started to become involved and they're shareholders in the business, and so that's why we're putting this buy-sell in place. Consider, do we want to allow mom and dad to be able to gift on an ongoing basis, utilizing the annual exemption amount and gifting some of that stock over time? Or do we want mom and dad to have to get all of the shareholders to agree? Now, if mom and dad are gifting equally to all those kids, they're probably on board with that. But if mom and dad want to maybe reward one of the children who's been putting more effort into the business, chances are that one that's going to get less isn't going to be really interested in signing off on that. The other caveat here is it's getting more and more common as probate costs get expensive to utilize trusts in estate planning rather than using wills. And so if one of those owners wants to use that trust for their estate planning vehicle, they may want that stock to be owned by that trust. And again, if you've got one of those agreements that says no transfers without approval, sometimes if we know that's on the horizon, we want to pre-plan for that and just allow that to happen. Other triggering events, common that it's those 4 Ds: death, disability, divorce, disagreement. Sometimes we want to consider, though, really whether in your particular business, whether all of those Ds need to be triggering events, whether we need to buy out one of those owners if one of those events happens. And one example that I offer is just the example of a real estate holding company. Phil and I start an LLC that's just going to own some real estate. It's going to get rented out on an annual basis. All that this entity does essentially is collect a rent check and make a distribution every year. If I become disabled, is that really important at that point for Phil to get me out of the business? Neither of us, our day-to-day efforts are really going into that business. Is it going to cripple the business or make a difference whether I'm disabled or he's disabled, or is our guardian perfectly capable of collecting that rent check every year and then eventually, potentially making a decision about selling the business? Well, depending on the situation, it may or may not. Now, if on the other hand, our real estate holding company is a pretty active multi-property sort of entity, and the deal is that I'm involved because I'm going to write all the leases and handle all the eviction actions. So now it's my personal efforts being involved there, and Phil's going to sell, and he's going to fill those units, and that's his part of the business. Well, he may be more interested in making sure that if I can't fulfill my piece of this labor now, that he can buy me out, he's in control, and he can either hire another attorney to do that or maybe get another investor in to be able to fill that role. So I just encourage people, when you put these together, and there's just a tendency to think, like Tom said with the life insurance policy, that it is what it is and you're just picking one off the shelf and there it is. Really think through those scenarios and what makes sense within your given business and industry. Another trigger that sometimes is included is termination of employment. In the corporate scenario, often owners are also employees of the business, and so sometimes if someone has been fired for cause, we also want to get them out as an owner of that business, and so that would be a triggering event that would cause that buyout and give the business the ability to buy that interest back. Kind of one of those side pieces that I mentioned is sometimes those buy-sells will actually include non-compete provisions. If any of you have dealt with non-competes, and I think we might have had sessions on this in the past, you've got to be really careful with employees and non-compete agreements. The court gives us more freedom for business owners and non-compete. So the last thing you want to do is for a business owner to leave and set up shop right across the street and become your competitor. So that's another kind of ancillary item that's sometimes handled within those buy-sell agreements. The next issue is valuation, and one of the reasons I made sure I was after Ben is I knew he was going to talk about these issues. So we've decided that an event has happened and there's going to be a buyout. That owner who has died, his interest is going to get passed out, or one of the owners has been disabled, they're going to get bought out. now what's the price? What are we going to pay? One common technique is to use a certificate of value, and this can be a good kind of year-end planning item between business owners, that we sit down at the end of the year and we talk about, what's this business really worth? Where do things sit right now? And we sign that up each year, and that's kind of our first point of reference as to what that buyout is going to be. If I was going to be bought out, or I was going to buy you out within the next year, what would that price be? Other ways of doing it, sometimes it's an asset-based appraisal. Using that real estate holding company as an example, what's the real value of that business? Probably whatever the price of the real estate is. And so that's a relatively easy item to secure, to figure out what that valuation is going to be. Sometimes it's formula-based. And this is another one of those areas where Ben is really good at developing formulas that give a good indication of the value of the business. And within some industries, there tends to be a real standard of how those formulas are set, or what other businesses look at when they would be acquiring that kind of business. One thing I'll just mention is the danger of book value, and I just had one of these cross my desk recently. The buy-sell that was drafted by somebody else, and their way of determining value was book value. Well, number one, what does that mean? What numbers are we really looking at? And number two, in this particular business, the way their books went, that was a negative number. So I've got to pay to get out. It's really important to have your professional advisors talking to each other and making sure that, because I can give you the most beautifully written, perfect buy-sell agreement, but if what we put in that agreement doesn't work with how your business is operating day to day, it's useless. Other methodology issues that you want to deal with on that valuation, what's the measuring date? Is the date of the event? Is it within a certain amount of time? What are we shooting for on that valuation date? If we're going with appraisers, how many? Does the business hire one? And if everybody's okay with that, that's the value that sticks. Is it the seller gets one, the buyer gets one, they each pay for their own? What if they're too far apart? Do we hire a third one to pick one? Do we average them? Just all those mechanics, and that who pays can sometimes get significant also. If anyone has hired up a business valuation, you might be surprised how much that costs for an in-depth business valuation. Then the really important part, payment. How are we going to come up with the money to buy this owner out? Sometimes those agreements will just say, hey, it's cash at closing, let's get it done. The problem is, will we have the ability to do that? Is that realistic? And so thinking about that in advance. Next option is insurance proceeds, and obviously Denny just did a really good job of helping us understand the different ways that insurance can come in and help fund. Are we going to do life and disability, only one or the other? Making sure we get those things titled up right so that what we think we're getting actually works together with what our documents say. And then those ancillary tax issues. I mean, Denny touched on the income tax side of things, but again, just putting on my estate planner hat, whether that money, that pool of money that we've set up, is included in that deceased owner's estate or not can be significant if Congress doesn't come to an agreement at the end of the year, and we go back to a $1 million exemption amount, so we can only pass $1 million of value tax-free. If that life insurance is titled in a way that it's included in that deceased owner's estate, we could trigger a nice 55% tax to go to our Uncle Sam, and I don't think that would be anyone's intention in putting these things together. So it's important to keep an eye on kind of all of those effects of the insurance. Sometimes we'll do a combination of cash and maybe a promissory note from the business itself. We want to set the terms of that note. What's the interest rate going to be? How long is the amortization? Is there going to be a balloon? And sometimes we'll include in there, again, with that idea of the touchstone is protect the business. sometimes we give that business the ability to defer payments for a certain period of time. If we come in to a tough time in cash flow, that maybe this payment is the last one. As we paid our employees and we pay for our materials, and this would be the last payment that would come in. But it really depends on your business as to whether that is a good or bad idea to include. So if you want to get going on this, again, do it when it's not needed. It's a lot easier to go through this process, and it is a process. It's going to take some time, and you are going to want to talk to your accountant and your banker and all of your professionals that you work with and value their advice. Take a look at that annually. Does that still make sense? Does our buy still make sense based on the way our business is going right now? And again, just stumping for get everybody on the same page. Denny can write you a great policy. If it doesn't work with what I put together for your buy-sell, doesn't help anybody. Then lastly, wanting to leave some time for questions here, just a few special items to consider. Sometimes we'll set out different rules for different owners, and this is pretty common in the parents transitioning the business to the children model. There are some opportunities right now, and if this is something that is of concern to you or your clients or people you're working with, we do know, as we sit here today, that you can give away $5.12 million and have that be gift tax free. As I said, if Congress doesn't take action on January 1, all those numbers go back to 1 million. And so for some business owners who are really at that cusp of wanting to get out, 2012 could be a good time to do that. Not only do we have that large exemption amount to work with, but we can structure some things to take advantage also. If we're giving children or other owners minority interest in the entity, we can utilize further discounting to get more leverage out of those exemption amounts. So start early if that's something of interest to you or the folks you're working with. And then finally, on those generational transfers, you know, parents always kind of expect that they'll die first and then the kids will die and things go in this nice, neat, orderly fashion. It doesn't always work that way. So don't forget to plan not only for what happens if something happens to a parent, but what happens if something happens to one of those children. And so sometimes we can be real focused on making sure there's life insurance on parents. Don't forget to consider what if that child passes away first. And sometimes parents are real surprised that this business interest that they gifted to their children, they may be in a position to have to buy back from their children's estates in order to keep the business running. So be sure not only to look from top down, but also generational from the children level back up to the parents as well.